Here are the big important things. One is proper position sizing. You ideally really want to do small trades, like I said, to keep you in the game if there's a downturn like today, if there's a prolonged downturn, and to keep you around in the game when the market turns around, right? You don't want to blow your entire portfolio within a few weeks. How do we set the position sizing appropriately? Most of the traders out there follow the rule of not betting or not risking more than 1 to 2% of the portfolio equity. Portfolio equity meaning the value of your portfolio. I actually have an Excel spreadsheet that I share with you here. Here's the download for that. But in it, you will find an Excel spreadsheet that looks like this. And that will basically says, hey, what's your portfolio value? It's about $17,600 right now. What is your desired risk per trade? Let's just say I want to just risk 1%. So what does that mean? Well, if I'm willing to risk at most 1% of my portfolio, then that means each trade can only lose $176 or $180 per trade. What does that mean? Well, let's go to a real example here. Take a look at Chainlink. It's actually in a strong uptrend across all 3 time horizons. This is actually a very interesting potential trade. The price is pulled back clearly now to a $30 level, which appears to be a decent support level. Even better is the 200-day moving average right here at $27. Okay, so let's just say we were going to enter this trade at $30 on this pullback. Let's say our bet would be that it bounces off of the $30 level, and my target would be about $35, which is the next resistance level. All right, so link $35 is my target price, and based on that, there's a formula here that says if your risk to reward ratio is 1 to 2, then your stop loss price should be about $27.50. $27.50 is actually just above the 200-day moving average. I might move it actually a little bit below that. It might quite well bounce off of that. But point being is, if this were how I set up the trade, my downside is 8%. That means my trade size should be about $2,000. If I go with $2,000 and things go against me and I lose maximum of 8%, well, 8% of the $2,000 is about $170. Right? So that's your risk per trade. And that's what dates the trade size. So if I go back to the presentation, in fact, on the next slide, the proper position sizing, there's a few variables that have a bearing on it. One is the portfolio value, the risk per trade. Like I said, we changed it to 1%, and then also your stop loss distance. That dictates how big is your trade size, right? In this case, $2,000. In this case, $1,300. So this Excel spreadsheet will help you with that. But in order to do that, you do have to upfront determine what do you think is your target price or upside level, and therefore that will determine what's your stop loss price. The other important tool is around the risk reward ratio. We talked about this when we discussed the trading ranges strategy, where we basically were trading between the support and resistance line, and we can use this for most of the other trade setups as well. And I think that a reasonable minimum risk to reward ratio is 1 to 2, meaning for every 1 unit of risk or $1 of risk, let's say, for every $1 of risk, I need potential $2 upside. Okay, and again, we can demonstrate it right here on the link example. if I think that my target is here 35, I think that's where the price can swing back to when it bounces off of 30. If that's my target and my entry level is 30, right? Then my stop loss price is 27.50. If I enter at 30, then I'm losing 250 potentially. If I do that, 27.50 minus 30 is 250. If I add some additional decimal places. So that's my downside per unit, and my upside is my target price minus entry price of $5. So the downside is 250, my upside is $5. So that's your 1-to-2 risk to reward ratio, RRR. Okay, and keeping this risk to reward ratio means that even if we are 35% of the time right, we are going to be at least breaking even. And if we are right 50% of the time, we're going to be making money. And if we are right 70% of the time, we're going to be making a lot of money. Okay, but of course, these target prices have to be realistic, right? I can't just say, yeah, my target price is 45. All right, I suppose you could, but is that realistic? So I think the realistic target is 35, and that really dictates my stop loss level based on the 1-to-2 risk to reward ratio.